Welcome to the Candlestick Forum Bearish Harami Training Program. For the next 45 minutes, we're going to go through examples of how bearish haramis work very effectively for showing a trend direction change. My name is Steve Bigelow. I've been in the investment area for over 35 years. I was a stockbroker with some of the major Wall Street firms on Wall Street for 8 years. Got out of the business because I discovered that most analysts on Wall Street didn't know what made a price move other than you try to find a good stock and hold on to it long term. Over the past 25 years, I have over the past 25 years, I've used candlestick analysis. Over the past 10 years, I've written 3 books on how to use candlestick signals effectively. Out of the 50 or 60 candlestick signals available in the Japanese universe, or Japanese candlestick universe, I discovered there was about 12 major signals. And today we're going to go through the bearish harami, which is one of the 12 major signals. The bearish harami has a distinct formula in that it opens below the previous day's close and closes above the previous day's open. This last white candle at the end of an uptrend, usually with stochastics in the overbought condition. Basically, it tells us that the buying has stopped. A bearish harami, in Western terminology, is known as the inside day. After an uptrend, if you see, especially when you see exuberance at the top, if you see them open it lower the next day and they close it lower, creating this bearish harami, it's a good signal that tells you that the uptrend is over. However, for confirmation, you'll want to see that they trade it lower the next day. A true reversal has other criteria which we'll get to further in this training. But essentially, the appearance of a bearish harami indicates the buying has stopped. Doesn't necessarily mean there's a reversal, but it will tell you the buying has stopped, either going flat or down. The harami also acts as a barometer. Notice how on this candlestick chart, the harami closed near the much lower end of the previous day's trading range. The further down it closes on the previous day's bullish candle, the higher the probability you're going to have a much stronger downtrend. A close up where it opens and closes near the top of the previous day's candle means your trajectory may be more like this on the downtrend. And the bearish harami can consist of other candlestick signals. Notice the hanging man acted as a bearish harami. But the indication requires the same thing, that if this is the indicator that tells us the selling has stopped as a harami and or as a hanging man, what we expect to see the next day to tell us the bears are in control is a lower open. The same analysis can be applied to a bearish harami shooting star. The shooting star itself would be a significant signal, but the fact that it also acted as a bearish harami was that much more evidence that the bears were starting to take control. As with any other signal, we would like to see that there's further selling the next day or the next couple of days that start your downtrend. And in this case, the spinning top told us there was indecision up here near the top and acted as a harami also, followed by a lower open the next day. As we go through this training, you're probably going to see a lot of things repeated or reiterated. For example, where do we see most people buying? They buy exuberantly at the top. Anytime you see that you're getting up toward the overbought area and you start seeing big candles, you start watching for a sell signal. In this case, that indecision was created by a spinning top and a harami, which both had the same requirements to tell us the bears were in control. If it opened lower the next day, it was time to get out of that long position and possibly go short. The color of the spinning top is not important. It basically tells you that it opened and closed below, or opened below the high of the previous day and closed above the open of the previous day. The combining factor, or the compelling factor, was that it opened lower the following day and started trading lower. That told you the bears are winning. Close out the position. As you learn how to identify the indications of a bearish harami, you can also use the other indications that occur with common sense application of investment practices that the Japanese rice traders provide with their graphics. For example, if we see a gap up in an overbought condition, that tells us immediately to start looking for sell signals. If we see a bearish harami, especially if it closes more than halfway down the previous candle, that basically tells us the bears have taken control. Even though they don't start the next few days with any aggressive selling, this basically told you that the selling had started. Start watching for a strong downtrend. The body formation of a bearish harami can be anything that represents indecision. For example, this bearish harami, which is a doji, told you to start watching for selling. This candle over here was after a big up day, followed by a lower open and a lower close, a much bigger candle. Another basic rule of candlestick analysis is the bigger the reversal signal, the higher the probability the trend has reversed. And there's some very strong statistical factors about a candlestick reversal signal and a non-signal. Many times people during training, when asked what type of signal this is, they'll immediately say that's a dark cloud. However, if you go back and review the fine details of a dark cloud has to open above any of the previous day's trading. So this is merely a down day in an uptrend. This is what becomes more significant when you see an actual candlestick sell signal occurring. In this case, the bearish harami. Always be suspicious that if you see a non-signal going against the grain of a trend, that's probably just a pullback versus an actual clear-cut signal. And as we continue through our charts, you're going to see there's a very few indicators on our charts. For example, we have this dark red candle, which is the 200-day moving average found in all our charts. The blue line is the 50-day moving average. The gray line is the 20-day simple moving averages. These three indicators are put on our chart because every major money manager in the world uses the 200, the 50, and the 20 simple day moving averages. The advantage candlestick analysis provides is it shows graphically what is going on in investor sentiment at major technical levels, such as moving averages. That gives us an immediate information of what's happening in investor sentiment if they're acting as support or resistance. This black line, which we're going to go through many times before the end of this training, is what we call the T-line. This is the 8 exponential moving average. This is probably the most valuable piece of information that you'll get out of technical analysis, is knowing in candlestick analysis, if you see a candlestick buy signal and a close above the T-line, you'll stay in that uptrend until you see a candlestick sell signal and a close back below the T-line. What boils down to very simple candlestick analysis, common sense, is The Japanese rice traders say if you see a candlestick sell signal in an overbought condition, the probabilities are extremely strong that you're starting to head for a downtrend. And the same use of that logic is the Japanese rice traders always say if you see a gap up in an overbought condition, start watching for a sell signal. And this will become fairly evident that by the end of the day, that if you see it traded up after it opened a little bit lower, but is now trading near the end of the day into the candle, you know you've got a bearish harami. You can start taking profits. As with all candlestick signals, the bigger the signal, the more compelling the reversal will be. Knowing the nature or the characteristic of a bearish harami, it pretty much indicates that you're stopping the uptrend. If one bearish harami tells you the bears are starting to take control, two bearish haramis is that much more evidence that it's time to be out of this position. Knowing that haramis stop uptrends, haramis become a very good indicator to identify once we've hit a resistance level. Remember, the more factors we can put into our analysis to tell us what's going on based upon the information provided by a candlestick signal, the higher the probability we're going to do a correct analysis. For example, if we see an uptrend, what's the uptrend mostly being targeted for? Where is most people watching to see what the target is? If you can see that the target is obviously the 50-day moving average, we can see immediately on a bearish harami, once it reached there, that more than likely it was not going to go up through the 50-day moving average at this point. Also, if we can see that the stochastics were in the overbought condition as we reach this point, more evidence that you're probably running out of steam and that the bears are going to start taking control. Knowing that a bearish harami is ending an uptrend, even if we see potential patterns such as the J-hook pattern that starts us back up, that if it went through the 200, we probably have a very strong price trend. However, noting at the end of the day that it had opened lower, tried to move up, but is closing in this direction, we want to be out of the position immediately. I am often asked, how often or how many days does it take for a trend reversal to be identified in candlestick analysis? The fortunate thing for candlestick investors is it's not days. It's the next day or the next open. If we see a bearish harami that occurred right at the 50-day moving average with stochastics in a downtrend, what we're looking for the next day to confirm is that they're going to be opening lower and taking it down further. Whereas other technical trading methods might need 2 or 3 days to establish that now the downtrend is in effect. And a resistance level can be anything that requires very simple analysis, such as a trend line. If we see that there's a bearish harami in this first pullback, and then comes back up again, meets the same level, and does another bearish harami, at least we have discovered where it's a good time to take profits. The information built into our harami pretty much alerts us that this is now going to become a resistance level, the 200-day moving average. Next day was a little bit scary. They were bringing it back up, but notice they couldn't get back up above the 200-day moving average. And then you had another selling day. This is the first indicator to tell us they weren't going to go through this level. It's time to take profits. Stochastics in the overbought area. A bullish candle that went through the 200, but a bearish harami, which is the signal, coming back down through the 200, basically tells us that's where the bears have taken control. Also, having the information in all the candlestick signals that allow us to decide what's going on in investor sentiment shows us that once we've come back up to a resistance level like the 50-day moving average, you see some selling. They take it back up. The bearish harami tells us they don't want to get going through it, and then confirmation the next day of a bearish harami heading back down is a pretty good indication, if you add us all together, that this was a resistance level. Anytime you see a doji in any multiple trading signal in candlesticks, that doji is usually a little bit more powerful than just a spinning top or some other indecisive day in here. That the doji followed by bearish engulfing does two things. Number one, we know that they're going to move the trend in the direction of how they close it after a doji, or even how they open it after a doji. And number two, we know that doji is going to have a more powerful move to the downside once that move is detected. Once a resistance level is obtained, as we can see in this chart, we started seeing spinning top, spinning top. They tried to take it up through, but the next day they did a bearish harami doji, which gave us a very simple result, or a simple trading strategy. Knowing the simple rule of the doji, it was going to move in the direction of how they opened it after the doji. In this case, when they gap it down, especially back below the resistance level, that told you if you were long, you should be out immediately. Very simply stated, if you see an uptrend, you start seeing indications of exuberance, like a little gap up, watch for your sell signal, a bearish harami. That begins this downtrend, or this stop the uptrend, let it sort out for a little bit, and then the downtrend started. Haramis need bearish confirmation to be indicating that that's the direction the bears are starting to move. A strong uptrend, in the overbought condition, and a bearish harami, this one would be a hanging man harami, and continued selling. One of the best indicators is if they close it below the T-line, you can start going short until you see a candlestick buy signal and a close above the T-line. Up here, the selling stopped as soon as we saw that bearish harami starting to be confirmed to the downside. Full confirmation, a bearish harami, followed by a lower open, followed by a close below the T-line, gives you high probabilities that you'll now be in a downtrend. And exuberance at the top can be easily visualized with candlestick charts because you can see the magnitude of each candle is starting to get bigger and bigger. The bulls keep taking it up. It's not until they see a bearish harami that the reversal or the uptrend stops, and then the reversal starts after that. Remember, the bearish harami acts as a barometer. Notice over here where we had a doji harami close right at the very top of that trading, which meant it was going sideways before they took it down. Also, it was very significant in the fact that it did do a bearish harami right at the 50-day moving average. Over here, it opened higher and closed much closer to the lower end of the trading range, which told us our downtrend was going to be much stronger. The significant downtrend is usually revealed once you see a bearish harami that tells you the buying has stopped. The downtrend gets a lot of energy when you see a bearish engulfing. Did I say bearish engulfing? Bearish harami. And then we see a gap down through the T-line. That gap down is telling you there's energy to the downside. Bearish harami, gap down. Gap down doji. Following day, bearish engulfing, left-right combo. even though they brought it back up. This was enough to show that the sellers were starting to take control. Had one day of pop, back down again for a very strong down move. The lack of follow-through is usually going to indicate that there's been a change of investor sentiment, meaning you see a strong uptrend, they're usually trading it up at the point where they get into the overbought condition and they start trading it back down. That's where you have to start watching for a reversal signal. And the bearish harami is one of the predominant ones that can be seen immediately, that if they open it lower and they can't get back up through the previous day's close very quickly, you better start looking to take some profits. A bearish harami closing near the lower end of the trading range is a good indication there's a reversal, number one. Number two, the T-line has one very simple rule. If you see a candlestick sell signal and a close below the T-line, you're in a downtrend, which makes this a fairly safe short in the sense that if it opened lower from this level, it would be trading down below the T-line after and confirming a sell signal, which would be a very safe time to get into a short position. That same philosophy works on a doji followed by a gap down and then a close below the T-line. Shows that there should be a very powerful change of investor sentiment, especially with the stochastics in the overbought area curling over. A bearish harami right below a kind of a downtrend, with selling continuing after that, stochastics rolling over. The more pieces of evidence you can put into your analysis that the bears are starting to take control, the higher the probability you're in that downtrend. A gap up in the overbought condition. An indecisive trading day. A bearish harami without the price moving too much higher. These are all indications that it's getting toppy, but the coup d'etat, the finale, is that they gap it down below the T-line, stochastics rolling over. That pretty much gives you a message that that's the direction they're moving after they've told you the buying has stopped. Doji, bullish engulfing signal, bearish harami, close below the T-line. These are all indications that we've probably gotten to an equilibrium state, and then the close below the T-line tells us we're probably going to be in a strong downtrend. As seen demonstrated, one of the strongest confirming indicators that the trend has changed is seeing a strong uptrend, seeing a bearish harami, followed by a gap down. Again, this tells us the buying has stopped. The gap down tells us the sellers want to get out of this trade fast, or the bears want to get out of, the bulls want to get out of this trade fast, pushing a lot of support to the downside. A gap down, especially a gap down back below the T-line, is a very strong indication they're going to take it back down to the next support level. Another strong confirmation is seeing a bearish harami, indecisive trading, followed by a bearish engulfing signal. That bearish engulfing signal following a few indecisive trading days gives you a clear indication that that bearish engulfing signal has now told us that the bears are taking control, and we usually do so, again, using the T-line as an indicator. Bearish engulfing signal, seeing further weakness, is a good time to go short. Also, another high probability factor is, like in any candlestick signal, the further a harami moves away from the T-line, the higher the probability there's going to be a reversal and a move back to the T-line to test it. What usually causes that move away from the T-line? Exuberance. You see the exuberance in the overbought area, definitely start watching for a sell signal. witnessing a bearish harami and more selling the next day, where's the likely target? Likely target is coming back to the T-line. At that point, you can always buy if there's a confirmed buy signal. Otherwise, you stay short. The further away you move from the T-line, the higher the probability they're going to come back and test it. But after seeing a candlestick sell signal in an overbought condition, there's no guarantee that it's going to come back, support at the T-line, and start back up. If it does, that's what we consider a J-hook pattern. But from this level, we don't know whether they're going to support at the T-line or not. Either get out of the trade and or go short, and do not reverse your trade until you see a candlestick buy signal and a close above the T-line. Again, the more factors you can put in your direction, gap up, away from the T-line, bearish harami, start taking profits. You can always buy it back. A strong uptrend, moving away from the T-line, a bearish harami that closes near the lower end of the previous day's trading tells you the bears are probably starting to take control. If it opens lower the next day, you want to start either covering your position or going short. As we can see, it was an indecisive trading day for the next 2 days, but this had already told the story. The buying had stopped. We're either going to be flat or in a downtrend, and when they started gapping it down, that told us the downward trajectory would be reasonably strong. Knowing what has occurred in a bearish harami, if we see a nice profitable trade, if it's a big percentage trade, take half your position off right here if you're in the overbought area. The next day, if they open it higher, at least you're still making profits with half the position, but you're in an overbought condition, a higher risk situation. Secondly, if they open it lower, looking like it's doing a bearish harami, you can sell the other half, getting most of the profits out of this trade. Analyze the total. A gap up, especially from a doji, but a gap up in the overbought condition. A bearish harami, followed the next day by bullish trading, but it was also a doji type day. Remember what a doji type day tells us. There's indecision. But there's also a very simple trading program using a doji. They will move the direction of the trend in the direction of how they open it after the doji. The next day they open it a little bit lower, take it down. So you've got a gap up, a bearish harami, a doji, followed by lower trading. This whole package, or a whole set of indicators, tells you you've probably hit the top. If it goes below the T-line, you want to stay short until you see a candlestick buy signal. Any buying after a bearish harami needs to be watched with great diligence, in the sense that if they are able to close it more than halfway up the candle that told us the bears are starting to take control, it negates this signal. You want to be long again. On the other hand, they take it up until you see a close above the halfway point of this candle. Assume that was stochastic slowly rolling over and you've seen a major candlestick sell signal, that you should be heading down. When they gap it down, that's very good confirmation that the bears are taking control, that they're going down further. Remember, a harami also acts as a barometer. Notice how this harami opened and closed right at the lower end of the previous day's trading. That tells you there's a lot of weakness. Next day, doji, then gap down. That's all information telling you that the bears have now taken control of this trend. A close near the top end of the previous day's trading. Notice a little hanging man just slightly below the low of the close of the previous day. Tells us there might not be as fast a downtrend, but it's still going to be in a downtrend as long as they confirm. Notice how far away you've moved away from the T-line. Now you start to have some indecisive selling. It's time to take profits. You can always buy back if there's buying back at the T-line. So use all the tools that you have available for your analysis. For example, we're in an uptrend. Doji gap up through the 50. That little gap up in the overbought area should be our first alert to tell us that we want to start looking for potential selling. After the big up day, we have a bearish harami. The next day they do open up positive, but it's also a doji, telling us there's not a lot of force to the upside. Following that day, there's a hard sell-off. But the bearish harami would have told us that this is where the selling or the buying had stopped. Even though there's a little bit of residue buying after that, the majority was done right here at that level. Witness a big bullish day in the overbought area. Look to start taking profits. If they open it lower the next day, especially in an overbought area, you might want to take off half your position, because what would happen if they open it lower and went higher? They'd be getting further away from the T-line. You probably want to take off half your position here. If it does go up further, you're still probably going to get a sell pretty soon because of the magnitude of the distance that you are away from the T-line. On the other hand, if you sell half here and it keeps trading lower, you can close out here and get the majority of your profits from this uptrend. A shooting star type signal, a hanging man type signal, a long-legged doji harami, a bullish hanging man type signal, but followed by a big bearish engulfing signal. You add all this together, it's telling you that the selling has started to come in, the buying has stopped. Again, analyze what's happening up here, especially in the overbought area. A bullish harami pretty much tells us the selling or the buying has stopped. Then they start selling it off, they gap it up again. But notice what they did, took it right back down. This whole scenario right here tells you the bears are starting to take control. Now they're back down below the 50 and the T-line. This is where you want to stay short until you see a buy signal. Knowing what the candlestick signals appear like and represent gives the candlestick investor a huge advantage as far as being prepared for a reversal. Bearish harami, overbought condition, right at a major resistance level. What are we expecting? We're hoping this is going higher, but as soon as they gap it down the next day, that should only lead to one action: sell as fast as possible. Other people are going to wait to see if they take it back up, but if they gap it down from a candlestick sell signal, especially a spinning top doji bearish harami, that tells you exactly what you want to know, that this is the same probability situation that the Japanese rice traders have illustrated to us for hundreds of years, that if you see a bearish harami doji gap down, close the position. And knowing the difference between decisive trading and indecisive trading allows an investor to start getting prepared. Bearish harami, doji spinning top, these are all indications that there's indecision between the bulls and the bears. But the first indication that there was selling coming into the play was the bearish harami, telling us the buying had stopped here. Just very clean visual information. And the visual aspects of candlestick analysis are greatly enhanced by knowing that the bigger the signal, the bigger the reversal, the higher the probability the downtrend is going to start. This bearish harami was almost a bearish engulfing, but essentially what's it tell us? It tells us that everything the bulls put into this trade the previous day, the bears took away the next day in the overbought condition. Then if we see it open lower the next day, we definitely want to be out. Even though it might not have closed below the T-line, probably this magnitude of reversal tells us there's definitely been a change of investor sentiment. A bearish harami right at a major resistance level gives you information that most other investors won't see immediately. It's telling us the buying has stopped. right there where we anticipate the buying to be stopped. Indecisive trading days tried to take it back up, but as you can see, they could not get it back up above the 50. This allows us to take profits and be off to something else. We could always have come back if it had come back and closed higher, but this signal told us that the buying has stopped. Take your money and go elsewhere. When everybody else is getting exuberant and the price is starting to skyrocket, start watching your sell signals. Notice how far away you are from the T-line. This is all just simple rules of when to take profits with a high probability that you're getting out at the right time. A doji harami, right on the major resistance level in the overbought condition. Take some off the table, take the rest of it off if it closes lower. This is a message. The buying has stopped. Notice how they opened it lower and brought it back up. A lot of people say, oh man, maybe I got out too early and they're bringing it back up. As long as this is a signal and it does not get violated once it is put in place, you got to figure you're in a downtrend. The point of investing is knowing how to find the signals that tell you when to get in and when to get out. It's not hard getting in, finding the right signals and the right patterns to get in. It's figuring out when to get out, because you always have that fear factor that you might be getting out too early. Here's a case when they move a big percentage, like in our trade on January 8th, 2013, in SPRW, when the stock was up 36% on the close of that day, that's a good time to take profits. Why? Most people can't make 36% in 3 years on their portfolios. If you make it in one day, take profits. Or take half your position off. The next day, what do we expect? Well, we're already in a high risk situation, being up 38%. If it opens positive and trades positive, all well and good. If it opens lower, that immediately tells us that the buyers aren't there. They might be taking profits. Close out the other half of your position. This isn't anything that takes any great strategy or great thinking. It's just common sense that if you're up that big and you start seeing a formation set up like a bearish harami, it's time to take profits. The probabilities are they're going to come back and test the T-line. That'll be it. This is the end of our training as far as the bear harami training. Again, everything is visual. The Japanese rice traders illustrated how investor sentiment worked for the past 4 centuries. The graphic depiction of how they work today is still going to be as relevant in the next 400 years. Thank you for listening. Hope to see you in the chat rooms.